Hey, how's it going, guys? This is Navi with TendieTrader. Welcome to the video. Excited to get into it today. Today's video is about Theta, one of my favorite Greeks when it comes to options trading, and probably one of the more important ones as well. So we'll talk about its impact, what exactly it is, and how you can use it in your daily trading. Before we get into that though, if you do enjoy the content of our videos and find them useful, don't forget to hit subscribe. We're coming out with a lot of great videos around options trading, and we don't want you to miss a single one. Again, you can also go to TendieTrader.com. Tons of great articles, videos, and content to get you started making those tendies. All right, so what is theta? Well, theta is one of the Greeks. And it's essentially the measurement of the option's time decay. So we know that options have a time component in their value, and ultimately they lose value as they get closer to that expiration date, right? So theta is a measure of the rate at which options lose their value as that expiration date draws near. So an example of that, well, let's say we have a call option with the current price of $2 and a theta of minus zero point 0.1. Essentially what that means, when you see that in your trading app, that means it's going to lose 10 cents a day simply due to the loss of time value or time decay. That theta value is going to change. It's more than likely going to increase the closer you get to expiration. But ultimately, for the simplicity of this example, let's say it stays constant at minus zero point 0.1. Well, what that means is in 2 days, the price of that option should theoretically fall to $1.80, right? So in those 2 days, you need to see movement either up or down, towards your strike price if you have calls, or down to your strike price if you have puts. If you've bought them at the end of the day. But ultimately, what we're looking for is how quickly am I losing value simply due to the time loss, right? With everything else held constant. And the interesting thing about theta and time decay over time is essentially that theta increases the closer you get to expiration, right? So, a lot of Wall Street bets and a lot of traders out there, they're looking for quick flips. They buy weekly options, and they're looking for significant price movements that overtake theta, right? So they're looking for a price movement that is going to make theta insignificant because the expiration is so close and you're experiencing larger amounts of time decay. On the flip side, traders that are playing a little bit longer out when it comes to their strike price, they don't care as much about theta, right? Because if they're 60 to 90 days out, their time is not eating into their premiums at as high of a rate as if the expiration was this week. So they can place trades that allow them to develop, or allow the price to develop, or the momentum to develop over time, rather than looking for extremely volatile actions. Earnings plays are a great example of where you can buy closer to the expiration, but you're expecting a more volatile move, so theta becomes negligible. So a few things to know. Like we discussed, longer term options have a theta of almost zero, so they don't lose value on a daily basis. This is great if you're expecting a long-term trend reversal or a long-term trend to develop, either to the up or downside. Buy far out. Buy, let's say you're trying to play Q3 earnings, buy 30 to 60 days in advance, and that gives you plenty of time, or even 60 to 90 days in advance, and that gives you plenty of time to not have to worry on the day-to-day basis of losing value due to theta. Theta is higher for short-term options, especially at the money options, and theta goes up dramatically as options near expiration. So that's really, really key, guys. If you guys are looking to do weekly options or monthly options, theta is going to eat a significant portion of that. Do not forget that you are going to lose value every single minute, every single hour, every single day that you're holding close to expiration. And last but not least, high volatility stocks have higher theta than low volatility stocks. So if you're keeping this in mind, the way you need to play theta is just dependent on how close to expiration you're buying. right? If you expect extremely volatile moves, buy weeklies, monthlies. Just if the volatility doesn't pan out, you are still going to lose value due to time decay. If you're buying further out, uh, not as much of an issue, but just know that the longer you hold and the closer you get to expiration, there is a point at which theta is going to start accelerating. And for me personally, I like to buy 120, 90 days out and sell around the 30-day time period. And if with a certain percentage of my portfolio, I am buying weeklies and monthlies, and I'm willing to eat the theta, it's typically around earnings that I'm looking for those extremely volatile moves that makes theta negligible. But at the end of the day, as long as you're aware that time is going to eat into your options premiums, you're already one step ahead of the curve. All right, guys. Well, that was it about Theta. A quick intro video just to give you a overall summary of what that is. If you have any questions, just drop me a comment below. But don't forget to hit subscribe if you found this useful. And if you have any ideas for upcoming videos or topics that you'd like us to explore, leave us a comment below and we'll try to get to it as soon as possible. All right, guys. Well, thanks again. This is Navi with TendieTrader. Thank you guys for watching. I'll catch y'all on the flip side.